G'day. Welcome to Lunch Money. We are your online and social media home for special situations, workouts and capital raising professionals. My name's Nick Samios. I am the Director and Fund Manager here at Hermes Capital, and I am your Lunch Money host. So welcome to episode 49. We're very excited to be closing in on our 50th episode. Today we are going to look at commercial property. There's a lot of talk about interest rates and property prices and what's happening with people returning to the offices and et cetera, et cetera. And so we're going to have a look at what's going on around the markets around Australia, and also we're going to be looking at a banker's perspective to see how the banks are dealing with their distressed properties, because I think on one hand we've got lots of great news about how the economy's doing and GDP and all the rest of it, but behind the scenes obviously there's a lot of vacant property about as well, and that means that there's a little bit of distressed property about the place. So we have got two experts to discuss this with us today, Luke Egan and Matthew Meynell, and we're going to get to them in just a little bit. But firstly, a little bit of housekeeping. I would like to remind you to share, like, subscribe, hit the notification bell if you're watching us on YouTube, and to share the goodness of Lunch Money with others so that they know that this is something that they should be listening to. Do us a favour and give us a rating on Apple Podcasts if you're listening to us there. We've got a few hundred subscribers via Apple Podcasts and Spotify, etc., etc. So do us a favour. Now, time for me to introduce our first guest. And our first guest is Luke Egan of Aster Alliance.
Hello, all, I guess.
G'day, Luke. How are you going?
I'm very well.
Very well. Luke, you're with Aster Alliance. Tell us a little bit about what Aster Alliance is and what it is that's been keeping you busy this week.
Aster Alliance is a multidiscipline property firm. We engage in construction and building projects across the country. We're also involved in real estate sales transactions in properties that are in mortgagee and possession scenarios. We also do a lot of consulting work for different bodies, whether it be aged care, health, in regards to their property portfolios and the best strategies for them. What's been keeping me busy? Well, this year is definitely fired up. Obviously, we had a very quiet year last year with everything that was going on with COVID, but construction is back with a bang. Most sectors are coming back to their traditional levels now, and with the infrastructure boost as well, with all that spending that's flowing into the commercial construction sector as well. The mortgage recovery sector, which we'll cover on, that's definitely heading up as well. All the moratorium periods are over, and we're starting to see a lot more stock come onto the market in some of these larger hotspot areas, like the apartment sectors in, as an example, Melbourne, Docklands and Southbank.
Now, I had dinner last night with some people who'd flown up from Melbourne, because you're based in Melbourne, of course, but you do work Australia-wide, and they were telling me about some work that they're liquidators, and Yep. They've been appointed to a property development that's not complete, so it's a work in progress, and the developer presumably has hit the wall, and they've called you in to try and work some magic. Just so, what is it exactly? What is it that you do in that scenario?
So in this particular example, it was a developer/builder who was overseeing about 40 assets, and he's obviously gone into liquidation. But there appears to be some equity in some of the properties. So this particular liquidator has brought us in to effectively QS, work out what claims have been paid to this point, what claims are still valid, and to give a cost to complete the project. So there's one particular project out in the northern suburbs of Melbourne, which is a childcare centre, which looks salvageable. So the numbers are starting to stack up for the liquidator now. So we're putting in the processes to move our commercial building licence onto the project and to complete that project and get it ready effectively for sale later on in the year.
Okay, and is that sort of typical of the work that you do, or is that just one of the sort of many?
It's one of the gamuts of our business. So the business is split into three sections. There is a general construction business, which would deliver services from a fit out, refurbishment and a new build perspective across a large variety of sectors. Then there
And
was
that's
that
just you doing work in your own right, basically.
Correct, yeah. So just working for B2B, for a private investor, landlord, everything in that respect. So there's no recovery aspect in that. But the other part of the business is working with lenders, insolvency practitioners, law firms, where there might be property that's in a distressed state, where we will come in and consult, advise, in some cases, like the one we're talking about here, complete a development, clean up property, and then execute the sale on behalf of a lender or a practitioner.
So you're engaging, real estate agents, and do you have your own QS, or you're engaging QS people, quantity surveyors?
So we've got a full estimating team who have worked across a number of industries for a long time. So engineers in-house, designers, we come with the full package. There are some aspects that we do have to outsource. We don't have our own surveying team for permits and so forth, but anything to do with the design and the costing element, we have in-house. From a real estate perspective, we've got some great people who have come out of the bank recoveries areas, who have a good understanding of collection of property and debt, and that have also been involved in the sale of real estate. So they work in-house, but we appoint all our real estate agents across the country. So we act as a third-party transaction manager.
Right. Okay. Well, that is very interesting, and I can imagine that when you've got a development, if someone's suddenly in possession of a development, the bank, whilst it's obviously always a part of the bank process is to be across how much the thing's going to cost to finish if they're doing proper development finance. Nonetheless, I suppose the liquidator's on the hook, and the liquidator's going to want to know, get their own opinion, I suppose, so that they cover themselves off. Now, listen, we are going to try to see if our other guest is able to join us. We're going to give this a go. G'day. Matthew Meynell is head of investment services with Colliers, and just having a flick through your CV here. Obviously, you've been with Colliers for some time, and you've had various roles there, including Asia markets, insolvency, property services. Did you sell the jam factory?
I did, as a matter of fact, yes.
That
was a few years ago now. I've sold a few nationally. So part of our role is, my role is national, so a number of transactions. Big one in Dorcas Street a few years ago as well for 165 mil. In Melbourne. Actually working on one at the moment in Lonsdale Street.
Right.
I'm in actually Melbourne today.
Right. Okay. Because you're Sydney based, but you're in Melbourne.
Yep.
And what is that? So head of investment services, what does that mean exactly?
So we manage our commercial transactions business, so selling buildings from sort of $10 million to $200 million in the Sydney CBDs, Melbourne CBD, national markets, and then the metro markets. But it also includes our mixed-use development product, our Asia markets business, so all our inbound Asian capital, as well as our restructuring side, so the distress side of the business. We do a lot of work with investment banks and working on workout solutions and strategies for assets that need a solution.
Okay, and so obviously you're in Melbourne on this large project. I mean, what is it that's been keeping you busy this week?
This week we've just we sold a building, to give you an idea of some of the scale, in 3.5 years ago now in Sydney, in St Leonards. That was for $295 million. We're just launching, so they're building 635 residential units.
Wow.
And they're selling at a rate per square metre around $20,000 to $22,000 a square metre.
Wow.
In St Leonards, so the North Shore of Sydney. But part of that project also has 18,000 square metres of commercial, which is being built. So Colliers are about to launch the leasing of that, as well as you've got 9,000 metres of retail where part of the VPA, the voluntary planning agreement, that's where a library is going to be included in that, and a retail component as well. So we're just launching that, which is a big project. We're just selling another one, mixed-use development in Parramatta, which will be probably $140 to $150 million.
Is that the one on Marsden Street?
No, this one is on Church Street.
Right.
Church
okay.
Street.
Well, there's a lot going on in Parramatta. I know that.
There is, yeah.
Yeah, my old stomping ground there. Okay.
Parramatta's.
Yep.
I was saying Parramatta is for the Victorians. It's the Docklands. We're really trying to build Parramatta. If you look at the Greater Sydney Commission, our 3-city strategy, Parramatta, was 780,000 square metres of commercial space, with the Parramatta Square developed by Walker Corp That'll take that up by about another 230,000 square metres, which is the equivalent of Barangaroo. Barangaroo is 265,000 square metres. So very shortly, you'll see the Parramatta commercial core CBD at around 1 million square metres.
Wow. Okay. All right. Well, that's okay. Well, that's. I mean, it's just so confusing what's going on in the property market. I mean, as we'll see as we go through these different segments and we go through some of the headlines that we've seen this week. So hopefully, yourself and Luke can help us navigate a bit of that. What we're going to do is we're going to bring Luke back. Now we're just going to start off by talking a little bit about the different sectors. I mean, let's start with hospitality. What are you seeing in hospitality, Luke? I'll start with you.
That's probably the slowest sector from a real estate and construction perspective from what we're seeing. Obviously, with COVID and everything that's happened, a lot of the hospitality sector has shut down in some capacity. Some have come back, but a lot are struggling. You're not seeing a lot of new sites being constructed unless you're a top tier sort of player. So I'd probably say it would be the weakest area in real estate at the moment.
Right. Okay. And then retail.
It's definitely firing back up. It's had a strong first quarter. A lot of the retailers are now they've definitely diversified in what and how they're selling and how they're marketing themselves. A lot of the big brands have acquired smaller retail businesses, and they're definitely showing a lot more strength on a month-to-month basis. So I'm quite bullish about retail. A lot of our customer base is retail focused, and the signs are pointing that it's going to be a strong year on the back half.
Okay. Any comments, Matthew, on hospitality or retail?
Yeah, I think I agree with Luke. Hospitality is obviously, there's a large contingent that is based on inbound international arrivals, and obviously it's no surprise everyone knows where that sits. I was on a plane this morning which was half full from Sydney to Melbourne, at the 6:05, so typically plane was 100% full. You look at people getting back into the CBDs. Currently, Victorian, close to the Property Council of Australia, is just trending towards 50% occupancy. It's about 45%. Sydney's now just about to get over 50%, and your regional areas such as, not regional, but your smaller cities such as Brisbane, Perth and Adelaide, they've been back around about 75 to 80%. So once you start to get that headcount and foot traffic moving through the CBDs, that starts to have a material effect on your hospitality. But we're still being affected by COVID with the areas, the one person per 2 square metres. So once that's wound back a little further, I think you'll start to see more people in the city and attending pubs and standing up and having a drink. That helps the hospitality industry. You had Justin Hems owns about 95 establishments across Sydney, campaigning quite vigorously to see that laxed a little further to make sure we can get people back into these venues. So to Luke's point, we've had JobKeeper, JobSeeker, codes of conduct and moratoriums all really wound back from the end of March. That's where we'll see some businesses that I think will fall over in the retail space because they were being underpinned by effectively government quantity easing, putting cash back into the marketplace. So I think we're in for a period here of the second half of Q2 and the first half of Q3 to find out which businesses really are sustainable, and that sustainability is built on foot traffic from a hospitality point of view as well as retail. Retail, all the REITs from an NTA, net tangible asset value, did wind back their vals between sort of 25 to 50 basis points. The investment fund managers are sort of saying that may have been a bit of a conservative approach, but we're of the opinion now that because of the level of equity and cash in the economy, we're seeing incredible competition for these assets. So I think a major influencer for that space as well is cost of debt, which obviously you can give us plenty of commentary on. But if you go back to 2009 to 2012, say GFC period, you're looking at about 650 basis points. Today, if you've got an asset which is with a strong leasing covenant, you're getting debt all in at 160 to 180 to 190 basis points, depending on your LVR and asset strategy. So because of that cash arbitrage, we'll continue to see some yields compress.
So that's all. Well, that's all retail, Matthew, that you've been talking about there, yeah?
Yes.
Yep. Okay. So moving on to offices, there are some weird solutions that are coming up, which we're hearing a lot about offices, people not returning to offices, and now we're getting this idea of turning offices back into clubhouses to lure workers back. What's going on in the commercial space? Are people returning to the CBD?
They are.
Yep.
We are seeing a trend back. We've seen a lot of employers. It's around collaboration and businesses. It's hard to build a strong culture in a business when people are, fractured from a work environment. There's an example. Ernst & Young came out and made a statement that they expect to have their Sydney CBD tower at about 35% occupancy by the end of this year and 75% by next year.
Sorry, say that again. Could you just repeat that?
35% occupancy by the end of 2021 and 75% by the end of 2022. So there's a number of philosophies in the marketplace where you'll hear hub and spoke, hub and home. So obviously hub and home grew from hub and spoke during COVID. So instead of being your smaller employment hubs closer to infrastructure, transport and residential accommodation, that became the spoke. That we then drifted towards what I refer to now as hub and home. I'm not a big advocate of that. I think, like everything in a marketplace, there's new ideas and thought bubbles, and this seems like a good strategy at the time. But at the end of the day, the only way a business can, in my opinion, fundamentally grow and build a culture is have people working together. And that breeds, and that also then benefits your retail sector, your hospitality sector by getting people back into the CBDs and getting activity. There's an example of some of the graduates of the big four accounting firms. They're starting as graduates. They've never been into their office and met their colleagues. Their idea of meeting their colleagues and building a relationship is via Zoom conference, which is not sustainable, in my opinion.
Yeah. Okay. So, Luke, what would you add to that office situation?
Yeah, I think to Matt's point, I definitely agree with him that we need everyone back in the office. It's where we all need to be. And I think from a property perspective, landlords are throwing great contributions back to tenants to get them on board. Some of the deals that are being cut at the moment on a longer term for tenants is just incredible, including cost of fit outs paid for and first year rent free. I think if that continues to happen across the country, I think we'll see a gradual increase in occupancy in commercial real estate.
Okay. All right. Well, look, I'm going to just throw you both a little bit under the bus here, if you don't mind. I just want to flash up slide 2, please, Yashi. ESR snares Blackstone industrial property portfolio for $3.8 billion. Now, if I can just find that article here, are you familiar with this sale, Matthew?
Yes. And
go on.
Singaporean sovereign funds, QIC as well.
Right. Now, I'm just going to read a little bit from this article. The price, which has set new benchmarks for industrial property across Australia, is the largest to be paid in direct property deal in Australia, outstripping a $2.5 billion portfolio of office towers that investors sold 6 years ago. Now, one of the chaps I was talking to yesterday, it doesn't say in this article, and I haven't had time to research. Oh, here it does. The consideration attributed to the portfolio is expected to provide an initial yield of 4.5%, with a 6 to 9 year weighted average lease expiry. Now, I'm told that 4.5% yield is knocking it out of the park. Is that right?
Yes, it is. And I think what's also of note of that is about $45 billion worth of underbidders in capital that's awash in the marketplace at the moment looking for opportunities. So you've got a transaction there at 3.8, but it's also the scale of the groups that were underbidders that have capacity to buy at this level. And if you just looked at it from a singular point of view, in the Australian economy, we've got $3 trillion worth of superannuation. About $860 billion of that is self-managed super. And people putting their money in the bank at 75 basis points or 100 basis points for a term deposit. What we're seeing is this weighted capital looking to be invested into real estate. And that's continuing to put pressure on yields. And what's sustaining that pressure is that very low entry point for cost of debt. So whilst that stays the same, we'll continue to find more and more people investing, and that's where we're starting to see syndicates together of some people putting together their superannuation money and combining to buy an asset for $20 million, $25 million on a yield now of circa 4%, where typically from an institutional point of view or a high net worth individual, they would normally look for internal rates of return between the 7.5% to 8.5%. Today now we're seeing that sub 5%. With that debt being so low, people are also now looking to adjust their investment strategy around cash on cash returns. And so if they're putting in a 50% LVR, what's their return on their cash investment, and hoping to get further capital growth, and their cash investment is the straight out return once you put leverage into that. So that's again another trend we're seeing in the marketplace. So because of that, I think we'll continue to see yields compress further, and that's on the back of, you know, obviously an exploding residential market.
Okay. I mean, that really is quite fascinating. I mean, what you've just said is that for a $3.8 billion portfolio purchase, there must have been, at least a dozen other bidders, I mean, assuming they weren't all that high, able to cut checks for that sort of money. And again, as you've said, you know, typically people would be looking for, you know, the 7s and 8s. You know, they're going to take a risk on commercial property, on industrial property, but they're having to reset their expectations, or they're going to miss out. Is really what's going on there. And what are your thoughts, Luke?
Industrial by far is one of the biggest growth markets in the country. I mean, if you jump on some of these online portals like Tenderlink, the majority of tenders that are going out at the moment is all industrial related. A lot of the property funds that I talk to, they just can't buy enough industrial land, and that's across the whole country. It's quite amazing just how aggressive some of these funds are in the amount of land that they're purchasing and the prices they're paying. But like we touched on there, some of the yields that they're getting, I mean, it just it stacks up.
Yeah, and why industrial? I guess, you know, commercial being office space, I suppose. Is it because money's just leaving these other markets and industrial's the next best bet after retail and after retail and commercial and residential, or?
There's been a fundamental shift there, Nick. If you look at where this industrial is coming from, predominantly it's chain logistics,
right?
And so if you look at a parcel, 3 years ago, 5% of every purchase from a retail perspective, 5% of that was done online.
Right.
What's happened here is we've seen during COVID a number of people like myself, who would not normally be someone who'd learned to shop online. You had to learn to accommodate and move forward. And one of those progressions, we're expecting to see the online shopping component head towards 12 to 13% by the end of this year. So if you look at what that means for something arriving in the country, being imported from overseas, that's got to land into the warehouse, have that then to be distributed. So whilst we've seen an enormous shift in that quantum of online shopping, that has a material impact on the chain logistics and warehousing to get those purchases to the mums and dads or the people who are buying them. So that's one of the main drivers. So people can see there's been an absolute pivot in the way people consume, and that major change is the online shopping. So that means that item needs to be landed in the country and then in a very fast period of time delivered, and that's through the IA changing robotics technology. If you walk into an industrial shed, for better use of word, today, they're a technology hub. It's like the data center of technology when you have a look at the way these items are moved from one part of the factory to the next. It really is robotic movements.
Yeah, I mean, this is sort of like the Amazonification of the economy. Is that what you're really talking about there?
Yes.
Yeah.
And you've seen institutional investors, where institutional investors, their strategy sat commercial, retail. And now we've seen the weighting of them trend now to get more weighting to industrial, and you've seen some of the largest institutions divesting of some of their office assets and reweighting to industrial, so buying these so they have a more diluted exposure to each individual asset class. But what they're trying to do now is acquire more industrial to have that more evenly weighted.
So does that mean, like, you know, shorting commercial, longing, you short commercial, long industrial, basically, is what you're saying? The other thing is, not all industrial is the same, right? Like, not every piece of industrial property is a massive warehouse that you can put robotics in and turn it into an Amazon distribution center. So what are the differences? Because, you know, I mean, there is still some industry here in Waterloo where I'm sitting. I mean, it's all turning into apartments at the moment, as you know, Matthew, being a Sydney boy. But are they different? Is all industrial being lifted?
Well, the change is land. So if you look at where you are there in Waterloo, there's been about 1.2 million square metres of industrial space being purpose-built alternate use in that South Sydney marketplace.
Yeah.
So you look at what's happened to land values and rents. So what you're seeing is you're seeing the smaller factories moving out towards infrastructure. So on the back of the infrastructure spend by the state government in New South Wales and improving roads and transport, large industrial users are chasing land values at $200, $300, $400 a square metre, $500 a square metre. If you looked around Waterloo today, your land value might be between $1,300 to $2,000 a square metre. So they need to find something from a construction point of view, the cost to construct, where they get their retail and their return back for their investors. So that's why we've seen the push further out to the western suburbs and around the infrastructure piece, because of the affordability. Land value has changed to your alternate use. So due to that change in use, like you mentioned at the Waterloo marketplace, that's now worth $12,000, $13,000 a square metre on GR, $14,000 a square metre for residential.
Right.
Industrial use is around $6,000 a square metre. So that's why that other value. So that's why they've gone out for cheaper land value, and that's what's driving those redevelopments. And they need more space. Like, it's not uncommon now to hear an industrial factory at 70,000 square metres, 80,000 square metres, 100,000 square metres. In the marketplace like Waterloo, Mascot, it's more fraction. So it's difficult to get something of that scale.
Right. Okay. Listen, I want to quickly get into, just quickly cover off on residential, and then I want to come into the bank debt side of things. And I'll come to you, Luke, because we were talking a little bit about residential earlier. I've got a headline here: investors offload Melbourne CBD apartments for losses of up to 40%. And let me just read a little bit from that article. Melbourne apartment owners have offloaded inner city units at losses of up to 40% in recent months, as some apartments continue to sit empty a year after Melbourne first went into lockdown to slow the spread of the coronavirus. City-based real estate agents say smaller apartments aimed at university students have suffered some of the biggest resale losses, but added that owners of large non-student apartments have also experienced substantial losses. So, Luke, you're seeing some of this stuff?
Oh, definitely. I mean, from my business's perspective, this would be probably one of the biggest hotspots for us in the CBD of Melbourne, the areas like Docklands and South Bank. There's been a large international flavour of investment in these portfolios, and with that drying up and tenants leaving and returning home, it seems to be a larger delinquency rate coming on board. It's quite incredible the numbers that we are seeing on a weekly basis from a mortgagee and possession perspective. With property prices still on the rise in Melbourne, for some reason this apartment sector just can't seem to sustain holding the possession of the property. So it's definitely going to increase over the coming months, and I think the vacancy rates will continue to grow.
And it's obviously in Melbourne. I mean, what about in other cities, Perth, Sydney, Brisbane?
Definitely starting in Sydney in some pockets, but nowhere to the level of Melbourne. Adelaide, Brisbane, Perth all seem to be pretty resilient at the moment, but I believe it will flow onto those sectors as well. I think Melbourne just seems to be ground zero from an apartment perspective, but there's also a lot of development down here as well, and I think that has probably also played a part in an overflow of stock in the market. Okay,
anything to add to that, Matthew?
Yeah, I think if you're an investor and you have the ability to hold, I would. If you look at Victoria and New South Wales, Victoria typically has a net population growth of around 115 to 120,000 per annum. Sydney's around about 100 to 105. Of that, typically about 75% of that is migration. So obviously that's come to a very rapid stall where that will come from. We're expecting to see that obviously change from 2023 onwards. But what we're also seeing is a lack of stock being delivered in the marketplace because people are unable to get pre-sales. So it just comes down to the thematic of supply and demand. And what you will see is an absolute undersupply of stock in years 2024 and 2025 and 2026, where these developers are unable to get the pre-sales. People want to buy finished products. So yes, there has been some drop and softening in pricing in the Melbourne CBD, not so the Sydney CBD. But what you've also seen, if you look at the real rapid rise in Melbourne and in Sydney at the moment for a house. Now, this is an old rule of thumb. If a house was worth 100 cents, a unit should be worth 60 cents in the dollar.
Okay.
For that difference in value.
That's an old real estate's rule of thumb there.
It is, and what you've seen, that divergence, that gap, got much narrower than that, because our unit values, because there's a lack of supply, there was a real pricing push. So they couldn't get the divergence narrowed, and now we're seeing with the house prices rapidly explode in value, you're starting to see that divergence take place again between the cost of units and the cost of houses. So what will happen is, for the great Australian dream for a young person coming through, Nick, your kids, my kids, one day to try and buy a property, they're now being educated. What you're going to be buying is a unit, because that's your affordability piece. And so with the lack of supply, that will start to put pressure on pricing. We're very bullish on the residential market in Sydney and in Melbourne. But there is an equilibrium happening at the moment, and there is some people that who bought off the plan 3 and 4 years ago, the height of the market in 2017. There's a bit of pain for some of those people, but we do know, if you look at COVID, what we've learned globally is Australia is the best destination to be in. And you look at the amount of expats that are trying to get back into the country at the moment. We'll start to see bonds being put back in place for skilled migration. There'll be visas put back in place, and they will all be looking for somewhere to rent and for somewhere to buy. And the skilled migration will be people looking to buy. So I'm very bullish on the market. There is an equilibrium. There is a shakeout happening, but that just is supply and demand, and that supply will be absorbed, and then the demand will take off considerably.
Okay, well that's very positive, but we might just splash a little bit of negative on that now, if you don't mind, just to put another. Now, Matthew, obviously you've had a bit of experience on the insolvency side, and Luke, obviously you're dealing with distressed property all the time. Let me just put up our last headline, which is from Bloomberg, talking about America. But the 12.3 trillion in stimulus killed the debt default cycle. Almost all fear of bankruptcy has been obliterated from bond markets, even though the global economy is still struggling. It's fair to say that 12.3 trillion stimulus seems to have killed off the debt default cycle. And it goes on to say, the simplest way to see this is quite basic. The lowest rated companies are enjoying the cheapest borrowing costs in history, yada, yada, yada. So investors have raced one another to lend billions of dollars to cruise companies and airlines, even as they bleed cash. So I just wonder. I know we talk. When we talk to our friends in insolvency and restructuring, the banks certainly don't seem to be in a hurry to move stuff on. So, Luke, are you seeing any changes in bank behaviour lately?
Look, it's the $1 million question, this one. How far is it going to go from a recoveries perspective, and what sort of numbers we're going to see? But look, last year, with all the moratoriums, there wasn't much enforcement from any of the banks. Those metrics have now stopped, and there are evictions happening. But what we're seeing is a backlog with the Sheriff's Department now, which is increasing the volume. I think as time goes on, more and more enforcement occurs. I think we're going to see more and more stock coming onto the property market. How many, I don't know, but I believe all the credit that was obviously washed into the system last year, it's definitely stopped a lot of these borrowers from having to enter into an MIP scenario, and I feel that as time goes on, we will see more and more delinquency rates across the major banks. We look at GFC time. It took a year, 2 years till we saw the full impact from a property perspective, and I feel it'll be the same with the current scenario.
And Matthew, you already mentioned before that, for example, when we were talking about this Blackstone property deal, there was just bags and bags of cash all over the place. So even if the first buyer hadn't have been there would have been someone else there with a few shekels less. But are you sort of, are any of the banks talking to you about distress, or from where we sit it, that they just seem to be sitting on their hands, and returns are so low it doesn't really matter. There's no sense of urgency. Are you seeing what are you seeing in the bankers that you speak with?
Yeah, look from our restructuring business. If you look at where our appointments are coming from, There's only been one that's come from one of the major banks. It's one, something over $20 million. On the back of banking royal commissions, but also, there has been a lot of good learnings from the GFC, and the credit policies are much tighter from the major banks. What we've seen from our appointments point of view, it's coming from second and third tier lenders. So your investment banks, your offshore groups, your groups that may not have done as much diligence on some of these funding structures and where they sat in the funding stack. There is a number of groups that have been second mortgagees and third mortgagees that are trying to take mezzanine, mezz positions to get a better return on their debt. We are seeing some appointments coming from those groups, most definitely. But I've been saying for quite some time, I don't think the real stress is going to come to our marketplace, similar to what Luke just alluded to before, until Q3, Q4 at the earliest of this year. Once we're really able to identify, if it's a commercial asset, what your true net operating income is, because whilst groups have been, your lessees have been supported by JobKeeper, JobSeeker, that's been able to contribute to paying the rents. There's almost a forensic audit taking place at the moment on your lessees to make sure they have the ability to pay the rents.
Yeah, well, that's interesting. I mean, I guess, as long as interest rates remain where they are, then that's going to be fine. If interest rates increase, then it's going to, it's going to change things. But something that you just said there, Matthew, it's interesting. I actually wonder whether or not the banks are going to have any problems at all as I think about it. I mean, because because of all this weight of money, there are so many new mortgage funds popping up every day. I mean, I was talking to a valuer yesterday, and I've spoken to solicitors. They're not getting bank work; they're getting work from second and third tier lenders. And there seems, I was talking to a valuer yesterday. He said he's accrediting a new lender every day almost. And so I guess anything that does get a whiff of distress, the banks won't be. The banks will just only have to sort of look at the client the right way, and they'll probably refinance, and probably most of the work will be coming from these other funds. Is that what you think, Luke?
Definitely. That's definitely what's happening at the moment. Second and third mortgagees, they're the ones who are enforcing. And it's probably worth noting as well, some of the major financial institutions come out late last year and said that they won't enforce on any loans until September, October this year. So they definitely can carry it, and that's what we're seeing at the moment.
Okay. All right. Well, look, we're going to wrap it up. So I'm just going to give you the opportunity to just give us some closing thoughts. I'll start with you, Luke, and then I'll come to you, Matthew.
Look, from my perspective, from a building and a real estate perspective, we are very bullish in the approvals and permits that are being registered around the country at the moment. From that perspective, working with landlords, private investors, everything is going gangbusters. From a recovery perspective, as I said before, the $1 million question is, how far will it go? We're definitely seeing there is more enforcement and traction, but time will tell on that, and I think over the next few months we'll start to see how big the hole is. Okay.
All right. And Matthew?
If you're sitting at home watching this, get back to the office. Don't work from home anymore. The economy drives on people getting back and having really strong CBDs. If you don't have a strong CBD, you don't have a strong metropolitan market. If you don't have a strong metropolitan market, you don't have a strong residential market. That's very evident. So we need everyone to do their bit to get back to work. We are, if you look at where we sit right now with what debt costs are, it's come out by the RBA very clearly stating we're going to be a low debt environment for the next 2 to 3 years. So that gives people confidence to go out and buy. What that does is drive employment if you have confidence. So I think we'll see that in the marketplace. There is definitely some headwinds in some sectors. There is no doubt about that. And we'll see a little bit of stress. But on the back of that, I still think you overlay 2023 onwards, when hopefully no more COVID major issues, we'll start to see more inbound skilled migration, and that will put population growth, and that puts pressure again on employment, rent. So I think what's in front of us is a very, very strong 18 months to 24 months in the property industry.
Yeah, look, I mean, I think it's, that's very interesting, and I suppose if you had to pick winners globally, Australia would certainly be on your very short list. There's no two ways about it. I'm not sure. I've said before, I'm not sure where else you'd rather be in the world. All right, well, look, we will wrap it up there. So, Luke and Matthew, thank you very much for joining us today. It's been very enlightening.
Pleasure.
Thank you.
Thank you, Nick.
Thanks, Luke.
Okay, bye-bye.